Hey guys, this is Rudy coming to you live from Palm Beach. Every now and then on our community channel of energy investors, somebody surprises me with something I've never heard of before. And in this particular instance, the company is called Woodside. And maybe I don't know about Woodside because I don't spend too much time and energy focusing on energy companies, uh, let's say predominantly in the Southern Hemisphere. One reason being that there aren't too many of them, right? But as I said, every now and then someone surprises me and I go, what? So I do take a look and see what's going on. So as I said, this particular company is called Woodside. It's actually an Australian company. And the genesis of why I made this video actually dates back to one of our community friends here, CP5898. I'm not sure exactly what that means. But when I clicked on his profile or her profile, I saw a really cool playlist, number of created playlists by CP5898. So if life gets you down a little bit and you feel bored and you need a little bit of uplifting, go and look at the YouTube channel profile for CP5898 and click on any of these. You can just click on the first one. It's kind of cool music, interesting folk style music. Anyway, CP5898 says, next comparison video you do, would you take a look at WDS? And I'm like, what the? I never heard of WDS. So of course, being me, I immediately go and Google WDS to find out what it is. It's trading near its 52-week low with what I believe is a sustainable 11% dividend. So I'm going to make two disclaimers here right from the get-go. Sometimes stocks are trading at their 52-week low for very good or very bad reasons. In other words, it might be justifiably trading at its 52-week high or low, or whatever the case might be. I don't know. The other thing is, when we say it's a sustainable dividend, well, firstly, we can only base that on what we know and what we can see. And my disclaimer here is that I actually literally knew nothing about WDS until I started looking at it. And because it's an Australian company, I don't have a lot of information available on my usual websites where I go and find information, including my brokerage sites. So in order to actually make a determination as to whether the sustainable the dividend, is sustainable or not, I'd actually have to do a deep dive in the financials. And my disclaimer is I have not done that. I'm doing a superficial 1 mile wide and 1 inch deep dive on WDS. Well, one way for me to start doing a comparison, since I was asked to do a comparison, is to find 4 similar companies that I'm perhaps more familiar with and compare WDS, which, by the way, is the ticker symbol for Woodside Energy Group, with 4 companies that are kind of similar, at least, as I said, superficially similar, because I'm not sure exactly what Woodside does. But of course, that's easy to Google and find out, right? So Oil Integrated International. And then I added 2 emerging markets integrated companies that I know quite well, one being Petrobras and the other one being Ecopetrol from Colombia. So I have a number of interesting companies here. There's a very significant reason why I added YPF from Argentina, because today is actually a fun day. If you want to know how fun the day is, Google Javier Milei, the new president of Argentina, and you can spend quite a few minutes enjoying a good laugh at the new president, who has said some really interesting things, including taking a scalpel or a sledgehammer to the Argentine government agencies, which are just burning through cash like as if there's no tomorrow, bankrupting the country, sorry. And as someone who's somewhat libertarian, that would be me. I'm not a fan of government at all, as you've probably figured out by now. And when an event like the Argentine elections happen, I absolutely thoroughly enjoy it. So I look forward to seeing more videos of Javier Milei, the new president of Argentina. I can buy all of these as a US person, or US domiciled person on the New York Stock Exchange. The industries, as I said, are similar. Down here at the bottom, I put a little green arrow here to say ADR. So these 4 companies to the right, so Shell, Royal Dutch Shell, YPF Argentina, Petrobras Brazil, Ecopetrol, in Colombia are ADRs, and ADR is an American depository receipt, which means I'm actually not buying the common stock. If I buy any of these companies, I'm buying the ADR, which is sort of an equivalent and very often trades at par value to whatever the stock is trading at on its local exchange or wherever else that particular issuer trades its public stock. WDS, on the other hand, I can actually buy on the New York Stock Exchange because it's listed on the New York Stock Exchange as Woodside Energy Group Limited, which is the company. So let's do a quick comparison here and see what's going on. So for the technical guys first, the 20-day raw stochastic, if it's above 80, it means the company is hopelessly overbought. So in this particular instance, you can see that way too many people have been jumping in on the bandwagon buying YPF in Argentina, and more than 80% Petrobras in Brazil, and almost 80% Ecopetrol in Colombia. Royal Dutch Shell looks a lot more responsible and reasonable, but look at the 20-day raw stochastic score for Woodside Energy. It's only 33. So this one's not overbought at all. In fact, it's borderline oversold. One of the reasons why might be because the analysts keep saying sell, 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 sell. Today's opinion is almost 90% sell, and a month ago, more than half of the analysts were saying sell this stock. It is horrible. Well, sometimes when it's horrible, it would be a good time to buy, right? So Warren Buffett once said, buy when everyone else is selling and sell when everyone else is buying. YPF, interesting one here. A month ago, everybody said sell it. And now today, suddenly it's a hold. But I'm going to show you what happened with YPF in just a minute as a result of the election. How about the price earnings ratios here? So TTM, trailing 12 months, I have nothing to report on Woodside, which means they didn't have positive earnings, or otherwise something is amiss with my bar chart. And then if I look at the others, most of these stocks, even Shell at Royal Dutch Shell at 7.26 is ridiculously cheap, but not as cheap as YPF and Petrobras. YPF has some macro risks there because of this new election, so I'm not too sure about that one. But Petrobras has certainly been one of the least expensive super majors you can buy for a long, long time in the past couple of years or so. What I'm doing here is I am comparing the market cap of the company. So market cap, in case you can't remember, is the total number of shares outstanding by the current share price to its annual sales. So quite literally on this statistical chart here, I am only looking at two rows, the market capitalization or market value or valuation compared to annual sales. So what I have here, the top line effectively is expressed in thousands, so I'm missing 3 digits here. So what you have is approximately $20.4 billion in market cap from a company that generates approximately $16.8 billion in sales. So if I divide the annual sales number into the market cap number, it gives me a ratio that I can work with, because for comparative purposes, that's quite neat to have, right? So anytime you want to compare different stocks, compare them on a variety of different metrics and not just something simple like a 20-day raw stochastic score or a price earnings ratio. So on this market cap to sales ratio, I have a company that has a market cap that is 1.2 times greater than the annual sales that the company is generating. The other 4 are very, very dramatically different. They are all below 1, and that's why I highlighted the other 4 in green and made this one red. And look, for the sake of example, Royal Dutch Shell is generating $386 billion in revenue or sales, and they have a market cap of only $218.8 billion. And you can do the math yourself here. The most interesting comparison would be Ecopetrol from Colombia. And say the most interesting is because their market cap is more or less the same, right? So I have a company in Colombia that is an integrated international company with a market cap of $25 billion. And I have a company in Australia with a market cap of $20.5 billion. So Woodside is generating annual net income of only $6.5 billion on its sales number. And look at EcoPetrol, 34.7 billion. Look at the annual sales, $175.5 billion compared to Woodside's 16.8. Now, based on what I'm sharing with you now, I'm not saying any one of these is a better buy than the other. You need to do a little bit more homework than that. But I'm saying just like at a glance, Woodside might be looking not good for not good reasons, right? So that's one of those comments that I made at the beginning of the presentation. Sometimes it's trading near its 52-week low for all the right or wrong reasons. This one doesn't look too good, so it doesn't fill me with too much confidence. We have a couple of interesting lines on this chart here. So this shows you a year-to-date performance of these 5 stocks that I'm comparing, and there are a couple of breakouts here. This, let's call it gold because it's a winner. This orangey line at the top is YPF from Argentina. It broke out sort of in the middle of the year and then steadily declined again until Javier Milei was elected as president. Petrobras, on the other hand, has gone up nicely, 51% year to date. If YPF had not broken out, it would have been sort of over here, right, with the other bunch sort of just below 20%. But Woodside has not been a good performer year to date at negative 13.5%. So not looking too good there. Let's look at YPF just quickly because it's fun, right? So Javier Milei gets elected and the stock jumps 50% in one day. Congratulations to anyone who's a member of our community here who was long YPF. It's a mighty fine day, and I'm happy for you. I hope you make lots of money, maybe take a little bit of profit and take some cash off the table. Depending on what your cost basis is, you might even want to take all the cash that you invested off the table and let the rest just run and do whatever it does. And that way your risk is not only mitigated, your risk is zero, right? So that's not a bad thing. If you have a stock, any stock that's just suddenly pops like this one did, look at your investment value and, let's say for argument's sake, you put $1,000 into a stock and it suddenly pops and now it's trading at like, whatever the stock price is, the value is like $3,000-$4,000. Sell $1,000 worth of that stock. Take all your cash off the table and leave the other 2,000 or 3,000 to just run and do whatever they do. So in Argentina, this is a large cap value stock. It's a $6 billion market capitalization expressed in US dollars. Got a PE of only 5. It's super cheap. And it's trading now near its 52-week high, which was $16. And as I said, there was a breakout in the middle of the year, but then look what happened after the new president was elected. So if you think geopolitics, politics in general are not major macro events, YPF proves us wrong, right? Let's take a quick look here at Woodside. So Woodside, as I said, is based in Australia. This is also a large cap value stock from an Australian point of view. You can buy Woodside for about $21. This is obviously in US dollars. The market cap also expressed in US dollars is about 40. So $40 billion market cap. Huge annual dividend yield expressed in US dollars, $3.33 annually on a $20 stock is yielding almost 16%, sitting way to the left of its 52-week range, right? $20, $20 to $27. So that may show you or make you think there's a little bit of upside here. Of course, the inverse is also true. It might even pull back further from here. It's grossly underperformed the traditional 3 top US indices, the Dow Jones, S&P 500, and the NASDAQ 500, and the NASDAQ easily outperformed Woodside over the last year or so. So collectively, this doesn't look too good. I looked at my global brokerage account, which is HSBC Invest Direct. HSBC still advertise themselves as the world's global bank. I have a few analysts here. So what have I got? 10, 12, 14, 15 analysts. Mixed picture, right? So even though there are 7 analysts who are basically saying buy or outperform together, there are 5 that say just hold it, 2 are saying it's going to underperform, and 1 says sell. For the technical guys, the chartists, I don't really look at charts too much, but many people do, and I appreciate their skill in doing so. Indicators are mostly bearish, so Woodside, as a general rule, is not looking too good if you want to open a new position here, other than for the fact that it pays a huge dividend, which, as I said at the start, I'm not entirely confident, or I don't know whether it's sustainable or not. But outside of its dividend and the fact that the stock price is really, really low, those two benchmarks or indicators are not sufficient enough for me to say this might be a good time to buy or to open a new position. In fact, I don't have an opinion at all. So I can't even make a suggestion here saying, might be a good time to buy because it's cheap, because you might be able to buy it next week for even less. I don't know. Smart people, Morningside here. This is an analyst report. It's a month old, 4-star rating. That's pretty good. Fair value estimate of $45. That's pretty good. Undervalued for the last 5 years, the light blue line here, right? So for 5 years, Morningstar has been saying that Woodside is undervalued, but it's still undervalued. So if you're waiting for it to pop, you might have to wait for quite a while, right? So they do say the fair value is 45. In this case, Australian dollars, currently 36.88. If that upside makes you happy, I'm not too sure, man. It's like this doesn't look too good for me. There's no economic moat. So just as a general rule, the financials don't look too good. The uncertainty is medium. I don't care about ESG risk at all. ESG is dead and buried, so it doesn't really matter. What do the bulls say? So Mark Taylor is a senior analyst at Morningside. He basically says Woodside is a beneficiary of continued increases in demand for energy. That's true. Behind coal, gas has been the fastest growing primary energy segment globally. That's true. Woodside is favorably located on Asia's doorstep. That's also true from a geographical point of view. That's a great place to be in terms of having Asia next door. Woodside's cash flow base is comparatively diversified, with LNG making it less susceptible to the vagaries of pure oil producers. It's arguably true as well. Gas is a primary component of Asian base load power generation. That's true too. Of course, Asia needs coal more than anything else, but they also need gas. Gas has around half the carbon intensity of coal. That's kind of like a save the planet type of statement. It stands to gain market share in the generation segment and elsewhere if carbon taxes are instituted, as some predict. So I don't know if you guys who are located down under can educate me a little bit on this. Are they talking about implementing or instituting carbon taxes down where you are? I don't know. Maybe you can let me know. I'm not up to date. What do the bears say? The global economy is cooling off and demand for energy will follow suit. I don't think so, particularly if Chinese growth rates taper. The global economy might be cooling off, but the demand for energy is just pretty steady eddy. In fact, it's going up. We currently use about 100 million barrels of oil equivalent per day, and it's been edging up gradually, pretty much based on anyone's analysis. So global economy might be cooling off, but the demand for energy is not following suit. In fact, more energy is necessary. You know that there's over 1 billion people on the planet who don't even have electricity. And there are almost 2 billion people on the planet who have it sporadically or intermittently. Energy demand is going up. It's not going down. You can, if you don't have enough energy in your investment portfolio, you're making a very, very bad mistake. And the energy to have in your energy portfolio is fossil fuels, not renewable stuff. So gas, coal, oil and gas, anything like that, good stuff to have in your portfolio, regardless of what the doom and gloom prophets might want to tell you. LNG developments are hugely expensive. This is a bearish case, and the balance sheet is at risk until such projects have been successfully completed. So that's a little bit of stuff about Woodside. So as I said at the beginning, I don't know anything about Woodside. I know only just a little bit more now than what I did when I first looked at Woodside. Thanks for highlighting it. This is really, really interesting. And maybe what I should do is spend more time looking at some of the oil, gas, coal type of companies headquartered, or it doesn't matter where their actual production is, but headquartered Australia, New Zealand, and South America, especially Southern South America, because I do look at South America quite a lot. But generally, I draw the line sort of around the top half or the northern part of South America, specifically Colombia, Venezuela, and Brazil, where I spend most of my time. And of course, in Africa, I do spend a little bit of time there because there's lots of uranium projects in in Africa. So I look at those on a regular basis, and but yeah, I have a bit of a blind spot in terms of the Southern Hemisphere. So if you guys can educate me or educate us, let us know in the comments. If we're missing anything or if there's a great opportunity regarding Woodside specifically. I'm not 100% sure whether it's a buy, a hold, or a sell. So I don't know. You can let me know if you know. Thanks for watching. Take care. Bye bye.